Larry, a fairly quiet session again today, and I think until today the S&P hasn't had two consecutive directly consistent sessions since about mid-March. It's been up, down, up, down, up, down. Today that ended. Do you start to sense a bit of momentum again?
Yeah, and really what's happened today is something we haven't seen in quite a while. We just saw a flight from safety into cyclicals, and obviously it all started in China with the CPI that came out yesterday morning for us, or yesterday evening for us. As you know, in the United States, we've really had a correction without a crash in the last 3 or 4 weeks, as all money has just poured into safety issues at the expense of financials, materials, and technology. Today, we're just starting to see that reverse a little bit. And I think at the end of the day, and Mark said it very well, in the United States here, it's about growth and it's about earnings. And right now, the market's just shifting around, just looking for its next leg. It is being propped up by quantitative easing, but right now, traders are on hold waiting for the next growth metric to kick in on growth or earnings to see which way the next leg is going to be.
Yeah, you mentioned ahead of earnings there. We're starting to see them come out. We had Alcoa yesterday. We've still got two of the big banks to come this week. What camp are you in terms of expectations? Because we're hearing from Reuters we should be looking at growth of about 1.6%. Others say it will be closer to 4% in reality, because we know that companies over there always tend to beat. What's your thoughts, Larry?
Yeah, it seems to me that they've been dialed down so much and our base is so low that I think, especially with JP Morgan and Wells Fargo, who both report in the U.S. on Friday, I wouldn't be surprised if they both beat. However, I wouldn't be surprised if the market didn't go up because of that, because I think, again, we're starting at such a low base that the expectations are that we need to have a big beat on both ends for the market to make its next leg. So bottom line, it's really a lot of waiting. We don't have earnings season in full force until about April the 15th.
Hi Larry, Mark Todd from FIG here. I'm curious about your thoughts on the consumer sentiment. How do you read that at the moment? In our mind, we're seeing a consistent drop in the level of confidence in the market. Is that what you're seeing?
Well, in America here, it's a little bit of the opposite, and that could change very swiftly, as you could say. But we've seen like consumer debt levels go down. We've also, on the flip side, have seen consumer credit go up, people spending more money on credit cards. We've seen auto sales revigorate, and also with the not building boom by any stretch, but just a little bit of building going on that's just creating an atmosphere of positive consumerism. But that might just be an Americanism where they just can't wait to spend money.
Larry, I want to ask you about spring swoon. A lot of people are wondering what it is. Can you tell us?
A spring what?
Spring swoon.
Oh, a spring swoon. I'm so sorry. Yeah, it seems like sorry, I'm far away from you. But in America, there's a saying that you sell in May and go away. In May, April is really the beginning of our spring season, and especially the last 2 or 3 years, we've had certain events that have caused the stock market to retrace itself April, May, and June. So it seems like, are we going to have another spring swoon, or is the market going to correct itself? I'm of the mind that we're well overdue for a correction. However, I wouldn't say we should ever get out of the stock market. We should never prepare for Armageddon. I would personally lower my allocation, my percentage to the stock market, just waiting for growth metrics to catch up. So that's what a spring swoon is.
Okay, and Larry, just lastly, finally and quickly, favourite trades at the moment, are you positioning yourself ahead of reporting season over there and spring swoon?
Yeah, I would be just the opposite of what the market's been doing the past few weeks. I still like financials. I still like materials. The bigger banks, or not the regionals per se, at the expense of consumer cyclicals. I would just take the other side of the trade. It's got a long way to unwind itself, and the multiple is cheap enough it can absorb some type of down correction.
Okay, Larry, thank you so much for joining us. We do appreciate it.